Welcome to Private Markets 360, your insider's guide to the world of private investments. Today, we're thrilled to welcome Liz Campbell, the Chief Investment Officer of Portfolio Advisors, a global private asset manager that specializes in investing in hard-to-access private asset classes and is the institutional investment arm of FS Investments. Liz has a wealth of experience in the financial sector, having previously co-headed Portfolio Advisors' global primary funds investment platform, where she oversaw approximately $2.5 billion in commitments annually. As Chief Investment Officer, she now leads the firm's investment activities across private equity, private credit, and private real estate. And notably, Liz has played a pivotal role in the firm's private equity specialized manager program, which focuses on investing in underrepresented, minority, and women-owned managers. This initiative has committed over $650 million in the past decade to nearly 70 private equity and venture capital funds. Liz, welcome to Private Markets 360. Thank you for joining us today. How are you?
Thanks, Jocelyn. I'm great and excited to be with you guys today.
Great. Well, Liz, as we're getting started here, we'd love to just go into your background a little bit. It'd be great to hear more about you, your journey through FS investments, and really within the private markets industry more broadly.
Sure. So I joined the firm about 12 years ago. I started out my career at a boutique investment bank focused mainly on private equity funds and secondaries and got to know portfolio advisors that way, worked with them on a client that we were representing, and then had some interest in getting over to the buy side. I'd spent the first 6 years of my career focused on sell side. So I got to know the team at PA well and joined their primaries investments team in 2013. It was a great platform for me to join. I can tell you a little bit about our evolution as a firm, but all of our investment activity is sponsor backed. So everything we do, all the deals that we do tend to come through private equity firms that we've got relationships with. So being on the primary side gave me kind of a front row seat into that, as well as very strong relationships with some of our top mid-market sponsors. Also worked very closely over that time with our co-investment team, some of our credit teams, and our secondaries teams, mainly on sourcing deals, but also evaluating them. So just a really good lens of our overall platform. And then took over the CIO role about 2 years ago.
Very interesting. So you have a great background that gives you a diverse perspective for sure. So I'd love to dive deeper into the credit secondary strategy. Can you elaborate a little bit on this particular strategy for us?
Sure, I'm happy to. And I'll talk a little bit about our private equity secondary strategy because that's what ultimately led to what we do on the credit side. So we started investing in private equity over 30 years ago, initially investing in private equity funds. Around 2000, we started getting a lot of deal flow directly from these private equity firms who came to us and said, we've got private equity firms, just for everybody's reference, are highly illiquid. So they're typically have 10-year fund lives where they invest over 5 years and then they harvest or exit their investments over the remaining 5 years. And so they started approaching us to say, you guys know us well, you know our portfolio companies well. We've got an investor who needs liquidity. Would you be interested in buying out their interest in the fund? And so that's how our secondaries investment strategy started. About 10 years after that, in 2012, we started seeing a lot more credit assets popping up in these broad private equity secondaries transactions, and nobody was really bidding on them. And so we saw an opportunity to start a dedicated pool of capital with a lower cost of capital than what we would have for private equity secondaries, focused exclusively on credit secondaries. The market at that time was very small, so less than $1 billion of annual transaction volume on the credit secondary side. Today, it's estimated to close to 30 billion in total transaction volume annually. So it's just exploded over the last several years, and that's been driven by the rise of private credit or direct lending funds. As that asset class has grown, it's led to a need for more liquidity in these relatively liquid vehicles. So that's how we got started on the credit secondary side.
Great. That definitely makes sense. And we hear you on the growth of that market, because some of the solutions that we have, we actually see the volume, and especially on the private credit side, it's bigger than we've ever seen before. So same trends. But I'd also like to talk a little bit about the opportunity in middle market private equity and what key characteristics contribute to its appeal as an investment. Why is the middle market an important area? And also, when you think of middle market, how are you defining it?
Sure. So for us, we've always focused on the middle market for a variety of reasons, which I'll go into a little bit more detail on. For us, broadly speaking, it's funny. If you ask 10 people what their definition is of the middle market, you'll probably get 8 or 9 different answers. For us, it tends to be transaction values of certainly under $1 billion and below. Our sweet spot, I would say, is really 500 million of transaction volume and below, and that equates to companies with EBITDA of kind of 5 million on the low end, up to 75 million on the high end. The reason that we like the middle market is, one, just the overall opportunity set. There are over 200,000 companies in the US alone that fall within that size range. So a much larger opportunity set, which means, the supply demand dynamics are very attractive. It means you can generally transact at more attractive valuations at the lower end of the market because there are just more opportunities and fewer. There's far less dry powder that's been raised to go after those opportunities. And then two, just a lot more what I call low hanging fruit to drive equity value. So the $5 million EBITDA company, you've had good growth, you've got relatively good scale, but there's a lot of opportunity to drive revenue growth, enhance operational capabilities to improve margins overall. So we really have a preference for when equity value is driven by underlying growth, fundamental company improvements, as opposed to financial engineering or using a lot of leverage to generate those returns. Over the last 10 to 15 years, we have been in a market with, until 2020, relatively low interest rates. When leverage is cheap, then you can rely on financial engineering to drive returns. But when you're in a market like today, it's a lot harder. And then you're more subject to the whims of the financial markets. Or say you hit a challenge, then you've got a lot more risk to deal with. And then lastly, I would say just the exit opportunities are much greater for smaller companies. And so you think about all the dry powder, all the capital that's been raised by large cap and mega cap funds. They love to buy good companies from smaller sponsors where there's already been a lot of value creation. So you can sell companies to larger private equity firms, you can sell to corporate strategics. Occasionally you can rely on the public markets to exit, but you're not overly reliant on public markets. And the challenge with that is that, in 2020, the public markets were largely closed to IPOs. And so you've got to hold on to your asset for longer. That can impact the IRR of your ultimate return. And so all of those reasons, we have always had a strong preference for the middle market, and I don't see that changing anytime soon, if ever.
Certainly no reason to. You've got so much optionality when you're flying at that altitude. I think it would be interesting to take a bit of a turn here to talk about the importance of discipline and operational excellence. So you've got a really well-defined strategy for how you're investing. One of the tricks is to keep managers in the range that you'll invest in, to keep them in the middle market. Can you talk about the importance of fundraising discipline in this cohort of managers that you're investing in?
Yes, it's critical and it's increasingly hard to find, I would say. The challenge is that we're dealing with numbers in finance, but we're also dealing with human nature. And anytime a firm has success, they have a lot more demand from investors. And investors can be their own worst enemies as well. We say we start investing, we start with a $20 million commitment to a private equity fund. They have a lot of success. We've got more clients that want to go in. And so we want a larger allocation going forward. That's the catch-22 with successful private equity firms. We really love private equity firms that are primarily incentivized by the potential for carried interest. So making most of their money not on management fees, but on really strong performing investments that generate a lot of carried interest for them. So we always encourage managers to stay small. We don't always do that successfully, but we have found that the best managers in our portfolio are the ones that have remained disciplined. Lower middle market managers who recognize that when they get much larger, the strategy inherently has to shift. And so, say you move up market a little bit, all of a sudden you're competing with other large cap private equity firms. You're competing with strategics as well. There are fewer companies to go after. So our job is to, when a group comes back to market to raise their next fund, to evaluate if they are raising a larger fund. Is this going to impact their strategy and, importantly, their competitive advantage? And so that's the catch-22 with investing in a blind pool, is to be able to look into the future and assess that. We've seen our most successful managers. Every firm wants to grow. We've seen some that have gotten creative and they've grown, I would call it horizontally as opposed to vertically. So they've got a ton of deal flow in-house. Their main strategy is majority control, by majority control of certain companies. And there's an opportunity to acquire significant minority, but not majority. Some founders just have an aversion to saying they no longer own 51% of their company. So they expand into more of a strategic minority strategy. So it is a tough thing to do when a manager has success. They all want to get bigger, but it's something that we focus a lot on.
Certainly keeps the job interesting, I'm sure. I want to turn our attention to real estate. So we understand it's a diverse asset class. There are some strategies that are gaining favor at the moment, others that are under pressure. Would love to hear your view on real estate fund investing broadly and kind of what the landscape looks like right now.
Yeah, it's definitely been arguably the most challenged asset class, over the past 2 years. On the PA side, we focus mainly on real estate secondaries, which can take a variety of different forms, and then to a lesser extent, co-investments. It's been a tough place, honestly, to invest in over the past kind of 18 to 24 months, just because there's not a whole lot that's been transacting. We and others have been waiting for valuations to kind of bottom out. I think there's an argument that they are close to bottoming out at this point. But we are seeing large portfolios come to market. So an investor will say, I want to sell, my interest in a bunch of funds across private equity, private credit, and private real estate. What we're often seeing is that they'll get the valuations they want on the private equity and the credit side. They won't get the valuations they want on the real estate side. And they'll say, you know what, I'm just going to hold off on selling the real estate funds for now and table that. So we've not seen a ton of transaction volume on the LP secondary side. We have seen a lot on what we call the GP-led secondary side. So where general partners or private real estate firms initiate a secondary sale themselves. These look more like co-investments than like traditional LP secondaries, where they're, going to recapitalize a company and they still want to own the asset, but they're going to recapitalize it because the capital structure has gotten out of whack, or they see there's additional growth prospects. So that's where most of our activity has been over the past year. And there's some really, really attractive opportunities as valuations have come down. The interesting thing about the real estate market is that it really has, it's not talked about enough, but it's gotten so much more attractive in the past 5 years. 10 years ago, when you're talking about private real estate, you're basically talking about office and multifamily residential. Today, as you mentioned, there's a lot more opportunity out there. So there are more niche opportunities like cold storage, life science portfolios, data centers, self-storage. So buyers of real estate secondaries and real estate co-investments have the ability to be much more thematic in terms of where they're going. So our team has done a really nice job, I think, of focusing on those more niche sectors that tend to be less cyclical or to be more resilient and in a market like what happened with COVID. So just a lot more choice out there for buyers. We are seeing more volume on the LP secondary side. Whether or not that's going to lead to an increase in transactions actually closed, I think remains to be seen. But we think now is as good a time as any to be investing in LP secondaries. When you think about the best returns, of course, common sense tells you that they happen when valuations have bottomed out. And so we think once that spigot comes back on, it's it's going to be one of the most attractive kind of return environments that we've seen, and probably since just after the global financial crisis.
And it seems like that aligns really well with what we're seeing in, all of the 2025 forecasts and outlooks, right? An increase in secondaries volumes at the very least. And then for those really smart investors, the ones who can find and structure the right deals, to your point, get the valuations right. So that's where all the opportunity lies.
Yeah, we think that's right. And same thing I would say would apply to credit secondaries. We just think there's a ton of growth potential in the transactions that are happening, transaction volume in real estate and credit secondaries. When you look at the private equity market, secondary market activity, the annual turnover rate is like 2 to 3% within private equity. It's historically been about 1% in real estate. I would guess that for the past 12 to 18 months, it's been even lower than that. So once, to your point, once that comes back on, we think there's going to be a really nice pickup in growth overall. And the opportunity set today is, it's just so much more attractive and diverse than it was 5 years ago.
And we've seen that there's so much dry powder out there too. So now we'll see some of that dry powder getting deployed. So that should be interesting to see as this market evolves.
Yeah, absolutely. And LPs have gotten, I think, much more proactive at managing their portfolios too. So when people think of secondaries, they think that, there's an explosion in volume, when there's volatility in the market, when the denominator effect takes place. But it's really, secondaries are used much more proactively by investors today as a portfolio management, a risk management tool. You'll get, there'll even be situations where, say a new CIO comes in and he or she wants to spend less time managing, tail end portfolios, funds that are 12, 13 years old. And so I think it's become a much less cyclical opportunity. So I think there's going to be pretty consistent growth in volume overall, and certainly no better time to be capitalizing on that volume when valuations are finally resetting within real estate.
Thinking about this investment environment that we're in right now, can you share a little bit about the manager selection process and the factors that you're considering when you're selecting managers?
Sure. So, I mean, the key factors, regardless of market environment that we look at, are what you'd expect. It's the team. Is the team built out well? Is it strong? Has the team worked together? One of the biggest risks that you have when you're investing in a blind pool is, does the team stay together? Do they have a shared investment philosophy? Do they have all the right processes in place? And so we do spend a lot of time on qualitative aspects like that. Of course, track record, but specifically, you're investing in a blind pool. So is the track record, do we think that the success they've had in the past is replicable in the future? Is that sustainable? And that ties into strategy too, as we were talking about earlier. If they've gone significantly up market, is it even relevant to what they're doing now? So those are kind of the key factors that we look at. Specific to today, we are unsurprisingly spending a lot more time on valuation, on liquidity of the underlying portfolio companies, of interest coverage ratios. And we do really benefit because we've got a direct lending team as well that's looking at all these underlying credits at the same time. So a lot more time on that. Are their valuations reasonable? Especially when a manager comes back to raise a fund, there is a perverse incentive to mark all the investments to cost or above. So are they being reasonable with valuations given how the companies have performed since they bought them? And then I'd say just another more general challenge is that we've been in an up market for so long, really until 2 years ago. It's important to ascertain whether or not a sponsor has really driven equity value by fundamentally improving the company. So by growing revenue, by growing margins, by paying down debt, and not overly relying on cheap leverage to drive returns. And so we're spending a lot more time on just understanding what they actually did, what the drivers of equity value have been. Because there are a lot of people that they probably did some good things, but everybody has benefited from the fact that the market has been up and to the right over for almost 15 years. And so that's a big area of focus too. And that just requires us to look very deeply into the underlying portfolio companies, and not just at, revenue, EBITDA, margin growth, but at the capital structure. And if if they got multiple expansion at exit, was that because they made the company strategically more valuable, or was it because market multiples rose over the same time period?
Liz, this has been a great conversation. We've covered so much ground concerning portfolio advisors, your strategies. Would love to wrap it up with just a question about your views on the market and what to expect as we're now into 2025. What are your thoughts on performance, on the deal environment, the overall health of private markets globally? Would just love to hear what you think there.
Sure. Yeah, it's an interesting time in the market. I'll focus mainly on private equity. I think 2025 will be somewhat a period of reorientation. So, what's interesting about the current environment is that despite some headwinds and volatility in the market, underlying portfolio company growth that we've seen has continued to be relatively strong year over year. I think the challenges that we're looking at or factoring into our own underwriting is certainly, what happens with tariffs. I think it's also, we've been in a period from a leverage perspective. We've been in a period where leverage has been cheap for a long time until 2022. We are starting to hear anecdotally and to also see some cracks, at the upper end of the market. You can only amend and extend for so long. At some point, when you get farther out on the liquidity spectrum, it becomes a little bit more difficult to manage that. So I would expect to see some shakeout just with some of those companies that are more highly levered. But we really haven't seen anything so far to suggest that growth is significantly slowing. Now, I say that with the caveat that we don't really have a great feel for the degree of tariffs or, where they'll be enacted, which industry segments will be impacted more strongly. But I do think that we benefited from the prior tariff regime. Sponsors learned a lot from that, and I think they've taken proactive measures to kind of get in front of that to the extent that they're able to. We expect secondary volume to continue to be very strong. There is so much unrealized value in private equity, but also in private credit, with the fact that exits have been relatively muted over the last 2 years. And so there's a real need for liquidity. Private equity sponsors have got to return cash to investors. Everybody's saying that DPI is the new IRR. So we don't see that abating, the secondaries volume abating at all. And we think private credit will continue to be quite strong as well. Banks have continued to retrench, and there's been a lot of capital raised, certainly for private credit. So we think that'll continue to grow.
Liz, thank you for joining us today. While we've spoken to allocators and secondary investors on the show before, we haven't had the opportunity to dive this deeply into the middle market, and specifically with middle market specialists before. So thank you so much for all the detail you shared. We wish you and FS Investments continued success. It was great speaking with you today.